Welcome to The Derivative by RCM Alternatives.
Top of the morning to all you trend followers out there. We're digging in deep with one of the longest tenured trend followers around in today's episode. Trend appears to be coming back in a big way with bonds selling off and commodities taking off. And we've got John Krautsack, Chairman and CEO of EMC Capital, who's been trend following in one manner or another with clients' hard-earned money since 1985. I was 11. Wow. So how do you stick around that long in the cutthroat hedge fund world? How do you stick with trend following through all its fits and starts over the years? We're finding out. Send it. This episode is brought to you by RCM's new white paper on, wait for it, trend following. Almost like we planned that. Check the link in the show notes or go to rcmalts.com and right up top on the menu there, click Education, then White Papers to download the newest paper where we get into what trend following is, why it tends to work in inflationary environments, why commodity exposure mostly sucks, unless you do it smartly via trend, and highlights on 5 trend managers we recommend. Many of them have been on the pod here, so you'll recognize the names. So go check it out today and let us know what you think. Now, back to the show.
Okay, we are here with the main man at EMC Capital Advisors, John Krautsack. How are you, John?
Hey, good.
Good to see you.
Good to see you as well.
Yeah, hopefully we're warming up here, and you're in the northern Chicago suburbs, right?
That's right. Yep.
So hopefully we're done with the winter, but I think it's supposed to snow like a foot on Thursday, right?
Geez, I didn't hear that.
Yeah. So let's start off with a little background. So you started as a clerk in the S&P pit, is that right?
Yep, that's right. I had a good friend of mine whose brother-in-law worked as a friend of mine whose brother-in-law was a big S&P trader, big local trader in the pit, and he asked if I wanted to go down to the Mercantile Exchange with them, and so I headed down there with them, and we went down. We got onto the floor. I've never been on the floor before. This is in the 80s, and just total chaos in my eyes. His brother-in-law comes rambling out of the pit. We go up to the Merc Club for lunch. The guy's not even paying attention to us. He's looking at his cards, looking at the ticker. Finally, he looks across the table and he tosses me his trading cards. And he's like, count my position. He's like, buy side on one side, sell side on the other. So I go through his cards and I'm like, you're long 80 S&P, big contracts. And he looks at me and goes, you want to work for me? I wasn't even looking for a job. I just was going down there to meet him. So it was a really a lucky start into the business.
For those watching on YouTube, I'll show a little, right? This was basically the trading card, just a simple 2x2 grid, right? And then I bought 5, I sold 10, I bought 5. And then I was a clerk down in the bond pit, and then our job was to go find to match up. Okay, you did those 10. Make sure get the other guy's little piece of paper.
That's right. And because he was such a large trader, my role was to literally get into the pit. And I was probably one of the only clerks that was in the bottom of the pit for the whole day, just getting cards from him and giving him his position, because he just traded such huge size. He needed to count like continually all throughout the day. And then I'd move about in the pit and match the trades with guys who traded with them, because he was just so crazy.
And tell the listeners, if you can, what that trading floor was like. I always say people would lose their minds if they saw the amount of paper on the floor, which we just talked about a little bit. But how do you describe it to people who never got that experience?
Yeah, I kind of equate it to a sporting event where the bigger the guy is, the stronger the guy is. I mean, you'd have so many people packed into these pits that if one guy swayed, the whole row of guys would sway. And and paper all over the place. The phone clerks would be shooting cards out to the brokers on the, it was it was crazy. I know the first couple of days working down there, I was so exhausted coming home on the train. Just it was just really intense.
Yeah, I always said I didn't make it. You'd get like dip spit spilled on you, fist fights every day. It was the Wild West, to be sure.
It really was.
What was your craziest story from on the pit days?
Well, one of my favorite stories is there's this one big local trader in the pit, and he would just overtrade and just get himself into trouble. So one day he shows up in the pit, and if you want to do big size 100 lots or whatever, you got your hands over your head. So he showed up in the pit, and he had a shoestring, and he tied his wrist to his belt loop, so he couldn't get his hands over his head to overtrade. And I just thought that was so funny. I mean, just all sorts of crazy
but he
things.
could still do a bunch of fives with the one hand. He just
yeah. It was, so there's so many stories down there. I mean, that really was it's wild that business gets accomplished down there. It's just with so much chaos, it doesn't seem like it would be that organized. But
right. And then clerks like you and me back in the day, right? And I'm showing up at 6 a.m. to go meet the other clerks and settle trades, out trades. Little did I know, like there were millions of dollars, right? Of like, oh, we're missing a 20 lot in bonds, and it's from 2 basis points higher or something.
Yeah, I remember right before Black Monday, like that morning, the guy I was working for, he was out a whole bunch of contracts, and he wasn't even in town. He was in Arizona, and I was running around trying to square him up before that opening, and that chaos, and giving myself a heart attack doing it.
Right.
I finally got a hold of him, and he left a couple of his cards in his jacket pocket, and didn't turn those cards in. So he was square, but I didn't know that.
So you run around for no reason. And so moving on, a little bit of the firm background. So EMC was founded by Liz Cheval, who is one of the original turtles, right?
That's correct. Yeah.
Yeah. And so we've covered the turtle program on here before. We'll put a link to our pod with Jerry Parker in there. You can learn more about it. So don't need to go too deep into that. But if you could, like, give us the personal side of Liz, what she was like, how she viewed the markets, kind of what you learned from her as you were getting into the biz.
Yeah, I think number one, she was a wonderful person. She was probably the best listener I've ever met in my life. I mean, she could meet the janitor, and the janitor could tell her what he's interested in, and she would go and like buy a book and give him a book about like that particular subject. She always wrote letters. She was just, her attention to detail was unbelievable. But I think probably one of the best things I learned from her is her discipline with this systematic style, that the quantitative side of how we research, how we don't change the portfolio just because things aren't working. All those disciplines to our style is really what I learned. I think that's why we've been around for so long, is because we've been so disciplined with when we're back testing our models, making sure that we're not overfitting, over optimizing our strategy. Those disciplines, she constantly wanted us to replicate what our research was producing.
And then what was her background before joining the turtle program?
So she had I think a math degree. So, she responded to that ad, and I think it was her and just one other person who one other woman who
Responded.
chosen. Yeah.
And then tragically she died. What's it been, 10 years or so? While on a business trip in China, right?
That's correct. Yeah, she was there to, we started using our models and testing our models on Chinese commodity markets, and the performance coming out of those markets was just fantastic. So she was pitching a Chinese guy who owned an FCM, basically pitching, how we started trading money for Morgan Stanley as an FCM, and then, how they grew that whole managed futures business out. So she was trying to form a partnership, and she went into the meeting, and she had a brain aneurysm before really the meeting even started. So that was in 2013.
2013. All right. Yeah. So let's move on to happier topics. But her spirit lives on in the firm, right?
Oh, so, it really does.
And so you guys have been running the classic program since 1985, is that right?
That's correct.
Wow, 40 years. So before we get into the nitty-gritty about your programs and all that, just let me ask, sort of like ask a married couple that had been married for 40 years, what's the secret? What's the EMC secret for having been around so long, right? There's probably been 40,000 hedge fund firms that have launched and died in those 40 years.
Yeah, I really think the secret is our discipline, our entire team's discipline, to our researching, to sticking with our models. I think that's the most important thing, because it's so easy when you're a quantitative firm to, if things aren't working, you start changing it to what the market's doing at this current time. And I think we see that currently, that there's a lot of, we were in a 40-year bull bond market, bull stock market, and it's very easy. There's a lot of firms who basically have like this long only element in their portfolios now. I think our discipline. There's some tough times not too long ago in the commodity markets. No big trends going on. It's very easy to want to kick those markets out of your portfolio. It's very easy to want to change your models for trading those strategies. And we just stay disciplined with the way we research, the way we run our optimizations. We stay disciplined with the diversification in our portfolio, whether that's with markets or with systems. And I really believe that is the reason why we've been around so long, because when it's time for managed futures to perform, we usually perform.
And that's interesting, is usually people hear discipline, right? And I'm thinking like, oh, I only risk so much on a trade, and I don't get crazy on the risk side. And that's why we've been around so long, because we don't blow up. So that's also true, but it seems more like you're saying, no, discipline to stick to our knitting within a framework of your evolving and whatnot. But right, it all too easy. Like we did a blog post on silver, trend following silver, and I think it had 19 straight false breakouts over like 11 years, right? Like nothing. And then last year had this big move, or it might have been 2020, but it had this big move. It finally paid out. So that's the discipline you're talking about, right? Of like, in order to take that losing trade over and over and over, knowing at some point it's going to pay out.
Absolutely. That was, you mentioned silver, and oh man, we wanted to kick that market out of our portfolio. But I also mean the discipline of it's all embedded in our optimization process, the risk you take per trade, the weightings of each market, your correlations between each market. Everything is built into that research optimization process. So sticking with the quantities that you're supposed to buy, it's the disciplines of taking putting on trades at you buying at all-time new highs or selling at lows.
Yeah,
that's a very hard thing to do.
The and what piece of advice would you give to some startup guys of eyeing that longevity, right? Of like, it's so hard because if I'm a startup, if I don't have the assets behind me, if I don't have the perhaps your guys' track record and capital built up, it's going to be way more tempting to pivot and say we got to stop trading this. We're going to go out of business. We're going to lose our clients, right? So how do you kind of weigh those two things? If I'm a startup hedge fund wanting that longevity.
Yeah, I mean, I think it's that's what's so hard about it is that you have to make sure that you have a good research process, and you stick to that process, even through hard times. And I agree with you. That's a tough hurdle right now, and the cost of just running a business right now, the price, the cost of exchange fees and getting live quotes and getting enormous amount of data. Like, we paid so much money for data. So there's a big hurdle. There's a big hurdle for sure.
And that's been a refrain on this podcast for a long time of like, hey, what if you have the choice, go out of business or change your model? Most everyone's going to change their model, right? They don't want to go out of business.
That's right. That's
but
exactly right.
From an investor, I appreciate I'd rather have you sticking in one lane, so to speak, right? Of like, hey, I know what I'm going to get with these guys. I'm allocating. This is the profile they're going to, right? If you start changing all this stuff, then as an investor, I lose confidence in that, not knowing what I'm going to get.
That's exactly right. And we've seen that. We've seen that with other managers, all of a sudden turn into a completely different trader. And, we owe it to our investors. I mean, we have two large investors who've been in the Classic program, one since 1989 and another since 1991. So they know what they're getting from us.
Yeah. And that's compounded rather nicely, right?
It sure has.
So let's dig into these strategies a little bit. The Classic program that we mentioned, the core of that is trend following, right?
That's correct. Yeah, we kind of bucket it in two areas. We do a technical trend following. We have two core systems that are under that, and then we have two systems that are more statistical momentum. We're trying to capture the same, big outlier moves, whether up or down, but we categorize them just a little bit different.
And expand on that. So what's the difference between that momentum signal and the trend following signal? Like a breakout versus a relative value?
Yeah, we don't do really breakout anymore. That whole style degraded, quite a bit. So what we're doing, like for the trend following slice of it is what we do is we have three core look backs, and we're trying to get confirmation on these look backs. So we'll look back maybe on the first parameter anywhere from 100 to 200 days. And then there's a threshold that market either has to be above or below in order to take a buy or sell. Then there's a medium term look back with another separate threshold. So we need confirmation on all three look backs in order to go to the next level. So the next level would be once we get confirmation that, let's say, the long-term look back, medium-term, and short-term look back are confirming that there's upside directional movement, then we have a volatility filter. And basically that's looking at current vol and comparing to past vol. And if it's over a certain threshold, we don't take the trade at all. If it's under it, we're allowed to take the trade. And then we have a little volatility move that must happen from the previous close, has to move in the direction of that trend in order for us to put that trend on. So we have two systems that have that same core logic, but in research, the way we make those systems different from each other is we pair each of our systems with a unique super value. And that super value gives that system direction on how we want that system to contribute to the portfolio. So an example of a super value for our shorter term systems, we'll pair a Sharpe ratio with a accelerated return numerator, and that will allow that system to be, it creates a shorter term system, and it also is a more nimble system. So it's responding fast.
So when
versus,
the super value is higher, you're more likely to get a trade there, or you're going to trade it a little larger?
well, it basically is using that super value across all that market data to have to fit those parameters genetically have to be, we populate each year new parameters for this core logic. So it gives that system a roadmap to how we want it to perform. We want it to be really, a real good risk-adjusted return from that system, versus those same core parameters on our longer-term trend following system. We might pair that to a return and a sortino, and then that system becomes way more accepting of volatility and becomes a much longer term system. So each one of our systems has a unique mathematical super value, and it tends to be weighted to closer to the most recent data. So there might be a Sharpe over 10 years times a return numerator over 2 years. And so during that optimization process, that's how these systems get new parameters. There's no wholesale changing in the parameters, and the parameters would be, okay, the first look back, maybe it was 150 days look back, but next year it might be 180-day look back. And the parameter that indicates it's trending could move as well. So we're optimizing to get those parameters, which make the systems quite different from each other.
And that's all machine learning, AI based, or you run that every year, hit a button, or is it ongoing? Is it like a rolling 12-month process?
Oh no, it's that the reoptimization is an annual process, and the genetic algorithms take place. So you're basically populating the strongest gene in each parameter.
Yeah, hit on that a little. Why do you call it genetic algorithms?
Because what it is doing is it's learning over time through our genetic algorithm. It's learning what the best gene or parameter that is that will go to the next generation. So as we do a forward walk, every time so a forward walk is basically, we don't just optimize a system to the whole set of data from 1980, let's say, until present. We walk through that optimization. So for example, we'll back test from 1980 to 1985. We'll come up with the core logic of a system, and in the 6th year, we trade that core logic in that. So we're trading out of sample. We're building an out of sample track record, basically what we're forced to do in real life as a manager.
Much easier if you could trade in sample. But not possible. Not possible without the time machine.
Yeah. So basically, each time we hypothetically have to trade those new parameters on data that we aren't privy to just yet. Those parameters get populated. So those are the best parameters, and every time we do a rolling optimization, the genetics of what comes to the top as the best parameters keeps on moving along. So
and that's across each of those time frames, each of those systems. So it'll change it on the longer term, on the shorter term. And then is that changing the portfolio construction as well, or that's static? Or you might add them over time, but it's not, the machine learning is not saying, and you should add carbon credits or something.
Right. No, we would have to just include that data into our optimizations in order to, add markets.
I love it. And so have you ever seen, when is that period? Are you allowed to say? And like, does it work really well right after the period and start to degrade? So you have to switch it over?
Are you asking when's the period where we add a new market in?
No, when you re-optimize, basically. So if you do it annually, you said, or periodically, but.
Yeah, so we have 4 systems in Classic, and so we have a set calendar date for each one of them. So we don't do all 4 of them at the same time. So we might, one each quarter is when we optimize them.
But have you over the years, like 5 years ago, did it take 3 years to degrade? Now it takes 1 year. Does it degrade at all, or you just find the new best one?
The part of re-optimizing is basically so we don't
degrade.
Yeah. So it's creating parameters and really looking forward more than backwards. Basically, we're trying to understand what are the changes in the market.
Do you ever do that? Look at the one that if you kept it just to drive yourself crazy, or no? Just take the new one and ignore what happened.
No, we definitely do. We look backwards and see what changes have been made. The best thing about, back 15 years ago, we would run an optimization and see what moved, what parameters moved, and then try to hone in on a range. So for example, the first look back is anywhere from 100 to 200 days. We would put a low look back and a high look back and have to optimize within that range. But now when we do genetic optimizations, we can just let everything, we don't have to put ranges on these optimizations. We could just open up the parameters as wide as we want and just let those parameters get populated, from a natural selection process.
And how crazy could that be? So could it jump from 50 days to 550 or something? Or there's still some guardrails on it?
Yeah, no, we never get wholesale changes, mostly because we're optimizing the systems to that specific unique, Sharpe ratio, basically.
Yeah.
The super value is always geared towards, so it always wants to stay within its longer term parameters, shorter term parameters, and that's kind of like the beauty of it. We know what kind of contribution each one of our systems is going to give us. I mean, obviously over time we can look back and go, geez, if we only traded the momentum system, the one momentum system, we would have been doing way better. But we want the diversification within the systems because they all go in and out of favor, just like markets go in and out of favor. Yeah. And we just want to be around for that.
And speaking of that, over time and in and out of favor, what does the model today look like in terms of what it was in 85, 95, 05, 15, right? So is it 50% the same, 5% the same? What does that evolution look like?
Well, I would say it's more like 5% the same.
Yeah.
These models are a lot more, sophisticated models. Back in the day when, Liz started the firm, it was one system and one risk management strategy that overlaid the portfolio with very little components to them. Now we have multiple systems. Each system has, multiple core logic to it. Probably one of the most important things we've done is so each system has its own risk management to it, where it gets in, where it gets out. But one of the best things that we added to the portfolio was this whole risk overlay, and it's built with components very similar to our system components. We take those components and we run it through an optimization every year. So the components would be, it would be like open trade, equity, a trailing P&L, a scale factor. And so what we see, what happens in Classic is we optimize those core parameters to a utility function. And a utility function is really like a satisfaction, how much are you willing to make and how much are you willing to give back on that. So we'll see in big periods of time when EMC's making money and the trailing P&L builds up, once it gets past the scale factor, we start lightening up the portfolio across the entire portfolio. And we can get to a point where we're cut back in Classic, 50% because the trailing P&L has really kicked in. And this is something that our clients have really noticed over the past, 10 years or so. We implemented this in 2007, and then we have continued to re-optimize it every year and add more, more components to it. But what happens is there's, you've been around this space for a long time. You see huge months that CTAs all do really well.
Yeah. And
like the next month, it's given all back. This component really helps us, retain the, the P&L.
Yeah.
It lowers our volatility. It lowers our drawdowns, and it helps us capture more of the trade.
Does it take you, right? Does it move you less positive skew? So I can see where you're coming from, right? That's the number one complaint about trend following. Great. But I made, I rode crude from $30 up to 90, and then it sold back down, and I didn't get out till it went back to 50. And people like you and me are like, hey, you still made 30 to 50. That's a great trade. But the investor's like, well, I had to report that loss from 70 down to 50. And it was painful to report to my end investors or to my family office or whatever. So that your utility factor is solving for that.
That's exactly right. Yeah. It's like a transformation function. And so what it basically does is it's looking at, it's like ranking monthly returns using an arctangent. So basically what it's doing is when you're looking back at your research and you're looking back at your monthly returns, it's going to reward a better negative return, so an improved negative return, more than it will reward an improvement in a positive return, if that makes sense. So you really, it's like a satisfaction thing. So, we would go to our clients and go, hey, would you rather us, make 25% or 20% and only have a couple percent, give back, a satisfaction? How much is enough?
Right. It ties. So did you do that with an eye towards the behavioral finance, right? That's a famous testing of would you rather, make $100 or lose? I can't remember what the math is, right? The famous experiment, but people would rather avoid the loss than get the gain, even if it's economically in their favor to go for the larger gain. They want to avoid the loss. That's
exactly right. That was what that concept was put in place for the utility function.
Which is weird, right? Because in your lab, in the scientist's lab, you'd be like, who cares what the investor thinks? Just I'm making the best product possible, right? Then that kind of goes into full Kelly betting and all that stuff, right? Of well, the best product possible might be I fully run this thing at 80 vol and I have drawdown, right? And I have drawdowns of 80%, but over 30 years, I compound the highest. Great in the classroom, not so great for real world and real investors, right?
That's right. That's right.
But that also leads me to so how much of that do you give up? Do you give up some of these right? You're in that scenario, you're probably never going to have the 100% return or like the huge outlier move in a
Yeah,
year.
I mean, it was in place during '08, and we had a really big year in Classic in '08, even
Yeah.
though we scaled that portfolio dramatically. So let's say, if we made 50% in '08, we probably left 20%, further in return on the table, probably. I mean, it's because we're cutting that thing pretty dramatically. And we don't just do like all of a sudden a 50% cut. It's like, as that P&L builds, we're doing a 5%, 10% cut. And, eventually when that P&L stops building, we stop cutting. But it's across the whole board. We've had so many different strategies to reduce that give back. And, one of them was just look at the market that's trending and making money, cut that. But that's a bad idea. It's a terribly bad idea.
Yeah. So I was just going to ask next, right? So that's on the portfolio level.
That's correct.
And so it's going to be, and does it look at each month? So if my best 3-month return historically was 40%, and now I'm at 38, it's going to start peeling back.
It's actually different than that. It's if let's say we have a trailing P&L over X days that gets above, let's say 9%. So once the trailing gets above 9% and it goes to 10%, we have a little scale factor that's built in. So what it really does is, if we have an open equity, we don't trade in our Classic strategy. We don't trade that open trade equity. So the scale factor is just using a multiplier against that open trade equity. So it makes the open trade equity bigger, which makes us take money off the table, basically.
Got it. Right, which is the classic from my days running a trend following, right? You would hit a big trade in corn. Now, right, say you started with $1 million portfolio, you make 200 grand in corn. Now, right, open trade equity, now you're at 1.2 million and you get a trade in silver. Do I size it off the million or the 1.2 million? Right.
That's right.
And inevitably you'd size it off the new 1.2 million. Now the corn P&L goes away and you lose on silver, and it just increases volatility across the board.
That's right. That's right. And I was just going to say, and from a standpoint of sizing trades in the portfolio, we do look at that market's volatility, short-term look at volatility to know how much we want to risk in that market. So each market has its own risk weighting, but then we take in consideration the volatility of that market, the current volatility of that market, when we put a position on. So the more volatile the market is, the smaller the size, and vice versa. If a market's doesn't have a lot of volatility, something like euro dollars, we're able to put on a bigger position. Right,
which is classic trend found 101, right? Like I'm doing 20 euro dollars, 1 palladium. And if there's the big outlier move, right, if it's 4 standard deviation move, I want to make the same amount in each of those markets. I don't want to unknowingly have like most of the portfolio's profits because this market's more volatile. And then you said something interesting before of if the volatility is too high, is that in each market or portfolio wide? If the volatility is too high, you're not going to take the trade.
So that component's within the system.
Got it.
So we've tried to, it's funny, we've really tried to get rid of that parameter in all of our systems, but it screens out so many bad trades that we need it at some level. Each system has maybe a different threshold. So some of our longer term systems are more accepting of expanded vol. So we want to make sure that there's not a trend, and just because of volatility, we're not a part of it. So that's the diversification within all the systems as well.
As my experience has, when volatility is expanding, 07, 08, right, 2020, 2021, 22 here, that's when trend following does better. But this is saying not just increasing vol, but if it's really high absolute level of vol, you're going to get whipsawed. You're going to get stopped out too soon.
That's right.
Yeah. So on to the other program. So we covered Classic. Anything else to add on Classic?
I could just fill you, the other types of systems that we have is the statistical momentum systems. And so those are quite different than having confirmation on 3 levels, like the technical trend following. So the statistical momentums are basically, we're looking at a shorter look back period of time. It's all time weighted to the present. And one of the systems is looking at a close to close basis. And so we do this analysis where we're looking at today's close versus yesterday's close versus the day before's close. And we walk back and forth this, what we call count against. So we're looking for closes in a certain direction and a lack of closes in the opposite direction. So almost like you would look at a manager where you have a run up, and then you just want to make sure within that run up you don't have like these drawdowns, these big drawdowns. So a lack of counter closes will allow us to put that momentum trade on. And then our longest term system is more of a looking at a shorter term look at the market, but really looking at the drift and the magnitude of the drift. So that would be a market that, if you looked at a chart, you just like, you go, oh, it's definitely going higher. But it kind of measures that on a short term. So the system, is more accepting of volatility, and it allows this trade to get put on like awfully fast. Over the last 5 years, that longer term system has been the momentum longer term system has been our most successful system in the portfolio. But all 4 systems we equally weigh just for diversification. And we want to just make sure that we are, we're not making changes just because of the results of our optimization.
Which is weird, right? Because you're like, we're going to do optimization, and this parameter set we think gives us the best chance, but then at the same time, sort of ignoring optimization there on that level. So it's an interesting yin and yang there of like, okay, I'm optimizing, but not over optimizing.
Right. That's critical in our research process. I mean, because it is really easy to say, oh, this system works great with this market, and this system works good with another market. So trade just those systems for those markets. That's just a real overfit strategy. Then what we do is we equally weigh all of our systems across all of our markets. So once we run an optimization and come up with parameters for, let's say, our short-term trend following system, those parameters that we come up with, we trade every market with those same parameters. So we're trying to build a robust set of systems that trades successfully in sugar as it would in Eurodollars, as it would in S&Ps. So we're not customizing the systems to each individual market or to each sector.
Which comes back to the silver comment, right? So even to the point where you would add something that's lost 26 times in a row, and no one in their right mind would ever trade on a standalone basis, right?
Right.
Which is crazy, but that's the power. Coming back, it's interesting to me, right? The momentum factors usually talked about in stocks, right? Single name stocks, not really in futures markets where we tend to call it trend. So like for you, what do those correlations look like? Are those models 0.8, 0.9 correlated, or you'll see much different trades?
Yeah, they still have a high correlation.
Yeah.
Because just like CTAs, trend following CTAs have high correlations because we're trying to chase the same
Yeah.
outlier moves. And so that just moves the correlations, up pretty high because we want all these systems to be able to capture trend or, momentum type moves.
Right, I guess
so the correlations would probably be, between our longest term system and our shorter term system, that would probably be the lowest correlation. So the longer term system goes out to about 120 some days, average holding period. And the shorter one's more like a 15-day. So there's plenty of times where those systems are actually on the opposite side of the market. So one could be short and one could still be long. So that'd probably be more like a 0.6 correlation with each other.
I guess another way to ask it, like you're capturing the momentum factor, even in the trend model, right? Like, is that the scientific explanation for why these things can work over time?
Yeah, I would say yes.
So circling back, so you guys have a few other programs, so let's talk through those quickly.
Sure.
Yeah.
So the other programs that we have, the first one we call EMC Alpha, and we really custom built this program for a client of ours who wanted to start a 1940 Act mutual fund, which is a game changer in our business. Basically, if people wanted to invest in our programs, it was typically, if we had a fund vehicle, then they could come in for a lower threshold. But if they just wanted to do a managed account, in Classic, the minimum was $5 million managed account. There's not a lot of guys who have, a $5 million that represents a small portion of their total assets. So now this mutual fund structure is a complete different game changer. Number one, you basically have a lower threshold in order to get into this alternative investment, and you have hundreds of brokers selling this to their clients versus one sales guy or two sales guys pitching it. So we're the sub advisor to this program called the Alpha program, and where it differs from Classic is we have 10 systems in the portfolio, and then we have sub-strategies, 4 sub-strategies. One of the sub-strategies is just short-term interest rates. We call it unconstrained rates. We optimize a few systems to that core strategy. So that differs a lot from what we do in Classic, whereas we're customizing systems to certain sub-strategies. And then we have a commodity-only sub-strategy that we optimize core systems to. And then we have a long-short global financial, which is basically currencies, fixed income, stock indices. And we optimize some more trend momentum systems to those sub-strategies using different super values as well. And then the very final sub-strategy is a long-only rebalanced sub-strategy of stocks, bonds, and gold. And that really helps smooth out the managed futures returns. But the fixed income and the stocks, they can all get flat and can get short. So right now in that strategy, we are short fixed income.
Well, there's a long only bucket, but then there's also the dynamic bucket that could go. So you might be long in the long only and short in the dynamic net.
Correct.
Got it.
Yeah.
And how do you do that? That's like to give you basically a positive carry that will keep you above water until the kind of alternative piece pays out? Or do you view it as the give you positive beta with protection via the alternative piece?
Yeah, I mean, quite honestly, the whole idea of the whole idea of this portfolio is we always, when we just had Classic, we always said, you want to combine this product with your other, your other holdings, and that's usually long stocks, long bonds, long gold. And so, that's a hard sell, because when a investor invests in the classic program, he doesn't look at it as a combined investment with his, their current investments, their long investments. It totally looks at it separate. So sometimes, we go through periods where they're not great. They're not great periods, and so
line item risk, we call that, right? Like they're just sick of seeing that line item, when if you bundled it, it's like, oh.
Yeah, exactly. So it's so we just decided that, it's hard to sell people on just the standalone. So why don't we build like a portfolio that's, it's more balanced as just a complete investment. So what's interesting is that mutual fund started out with 5 million in 2013. It's over 500 million now, and really where they're selling that product is basically to brokers' fixed income sleeves. They started out selling it to like these
managed futures, and then
managed futures, or even in someone's stock bucket.
Yeah.
Now where the big attraction is happening is
bond replacement
fixed income. Yeah.
Interesting.
So it's shooting more towards single-digit returns with single-digit volatility. Very different than what classic shoots for.
And then what else? Other programs?
And then we have another carve out within that EMC Alpha program that's in the mutual fund. We also trade ETFs in that portfolio. We have an EMC Alpha Plus strategy, which is a levered up version from that Alpha strategy, and it's all futures, no ETFs in that portfolio. So it's very similar. We built it very similar to Alpha. It's just a levered up version of that.
Jumping around a little bit here, we touched a little bit on the AI machine learning. Just give us a little bit of like, what's your take on all that? Indispensable to you? Should have done it sooner? It's just a fancy spreadsheet. What's your take on how you guys use the machine learning and how you value it?
Yeah, I mean, we really value it a lot because it's an automated research process for us now. I mean, we used to sit at a conference table, everyone in the management group, and just spitball, just figure out what changed in the system. Is it good? Should we allow it to change by that much? This is a natural selection process that, coming to these conclusions, we're able to come to them a lot faster because of the genetic optimization that's happening. There's a lot of different interpretations of artificial intelligence. There's artificial intelligence where people just throw a whole bunch of parameters, into the code and let it try to figure out what's the best parameters. We don't do it that way. We basically have core logical parameters, and then we're directing these systems to get the best parameters within that core logic. So it's quite different than some of the artificial intelligence we've had.
Yeah, I think I view it as like outsourced manpower, woman power, right? Like you're just, instead of a room full of 1,000 people crunching through all this, you have the machine do the work.
That's exactly right. Yeah. So we really believe in it, from not only from a system building idea, but also from that overlay risk management. That's really helped us outperform a lot of our peers, especially in good times.
That's easier to tell investors about too, instead of like, well, I don't know why we went long that, but the AI did it. Yeah, it seems to have worked over time. And the classic AI, right, is like going to optimize to what's working over this X period where you've kind of said like, no, we're going to have discipline. And even if something's not working in that period, we believe in it philosophically and we're going to keep it in the portfolio.
Right. Yeah. We look at the whole portfolio, when we run these optimizations. We're not just singling out markets. We will take some outlier performance in our back test and remove those markets so they don't skew our results by too much. Like if the central bank devalue their currency or whatever, and that had a huge move like way back when Mexico had their big devaluation. It really spiked our P&L, and so we kind of take some of that noise out just so it doesn't skew the results.
Take out the largest loser too. I'm thinking of the Olympics here. The largest loser, largest winner judge scores get thrown out.
That's right. Yeah. Just some of the ones that can really skew.
If trend following starts to go really back in vogue here, right? It's had a great 21. It's doing great so far this year. If hundreds of millions of billions start flowing back into the space, do you have any reservations that it gets too big, that'll degrade the core signal there? What are your thoughts on the old trend following's too big angle that was prevalent 5-6 years ago?
Yeah, I personally, I think you can get skewed when, if you look at the 40 years that the bond market has been, has gone up, and you customize your strategy to have a long bias, or you customize it to, have a long bias in stocks. I think that could definitely hurt, if people have adjusted their strategies to that past market environment. I think then it could terribly degrade. But from our standpoint, we build the same parameters that get you in a long trade are the same parameters that get you in a short trade. And then shorter versions of those parameters get us out of those positions. So shorter look backs and thresholds get us out of the position. So I personally don't believe in like, that the more money that comes in, the less success we're going to have. We would have to probably weigh certain markets like lumber and orange juice and some of those smaller contracts. We probably have to weight them too low to actually participate in them. But at this point right now, they are light weights, but we can still trade those markets and have them add value.
When asked another way, what would you have to see in order to be like, this has gotten crazy? Like these, as soon as there's a breakout, the thing spikes this much, we're not able to get in soon enough, right? Like what kind of things would you have to see to be like, there's too much money chasing these trends, which is a odd question in and of itself, because what time frame is it on? A 10-day time frame, a 100-day, a 200-day, right?
Yeah, I mean, we would definitely have to, obviously, if we have to look at slippage, type effects, we'd have to look at all our custom algos that we built for putting trades on. We'd have to look at our market weights. There'd be several things, if we start seeing, moves that we, can't get in time and can't get out in time. We hope that through our optimization process that those parameters will all adjust to that current environment.
Right.
So,
but my counter argument would be, the more the merrier. That's going to drive more liquidity, more people into the market. And if your models are better than the next guys, there could be opportunity there. Right?
Opportunity. That's right. Yeah.
And so you mentioned everything being the same on the long side and the short side. The bond trade we talked about, right? So bonds basically went straight up, rates down for 30, 40 years. two things there. One, back in the day, everyone said managed futures returns were juiced because they could hold T-bills, but we'll ignore that for now. But just right, if they were a participant in that huge 30-year bond trend, now simplistically we can say, oh, if that reverses, if rates go back to 15%, whatever, there's going to be a huge downtrend in bond prices, rates up. But Roy Niederhofer, some others have pointed out like that won't look the same because of the cost of carry, because the curve will be different. So what are your thoughts on the rates up, bond prices down? Is that going to be a mirror effect? What's it going to look like for your programs and managed futures in particular?
Yeah, I mean, we trade across, the whole curve. So we're trading short-term interest rate products, we're trading medium-term, we're trading long-term products. And so we built these systems based on the data that we had, which was really skewed to the upside. But for us in particular, I think, we don't really look at it, is it going to be a different type of trend? We're just trying to capture directional price movement. So, I mean, the amount of P&L we've already picked up in the euro dollars over the last, couple of years signals it's a pretty good trend right now. I mean, almost better than the amount we picked up on the upside. So, it all depends. I think it depends on the volatility of the market. It doesn't, euro dollars, the vol has just picked up big time in there. So our strategies could miss if they get screened out by vol, but we got in so early that all of our systems are already positioned in those markets. So, they could be right that, this is going to be a different type trend, but we basically are just building models that catch, try to catch outlier moves, and however big that is, it is. I mean, we're hoping that our risk management overlay, ends up capturing, scaling back when we do capture these moves, and like right now we have a pretty decent scale going on in the classic program. So if those euro dollars reverse, we're going to capture a big piece of that already.
It sounds to me like you're saying, like, yeah, maybe that trend looks totally different. You're not going to make as much as you made on the way up, but unless you set your whole model up as like that's the main factor, right? That you wanted, that your whole performance is based on it looking exactly the same. Right. If you don't do that, then it's not necessarily a problem. You're just going to get what you get and have a nice day and move on to the next one. Right.
I mean, look, I think probably most investors didn't think that interest rates could go negative and could have put into their models. You can't buy bonds when the rate is under 1% or whatever, and
and we've talked about that before, but what do you do with bonds at the zero bound, and why would you go long there? There's no more room to go. But 2019 was it, right, where there was tons of money made in boons and bubbles and all that German stuff of going long at the zero bound, and it basically it went more negative and you could make money.
I mean, and the only data that supported was prior to this all happening was Japan. The euro yen, the rates went negative, and the volatility just completely died out. So it was almost like a flatline movement on a chart. What we did as a manager, just not being in that type of environment before, is we just lowered our risk. Our market risk in there, because obviously with no ranges, we would be putting on massive positions based on the volatility of that market, which is a very dangerous thing to do. So we pretty much cut the leverage in that market. That's sort of like that's definitely a discretionary move when it comes to, our research. But we just felt that, without any data supporting what could happen here, that we'd be best off protecting ourselves.
Love it. And then let's talk we mentioned lumber a little bit. We just had a pod a couple weeks ago on lumber, talking about the supply chain issues, the beetles because of climate change, all this stuff. So it always amazes me, right? Like, no offense, but you don't know anything about all that stuff.
Exactly.
Yet, right. But you might say, oh, no offense taken. That I love being able to make money off something that I know nothing about. Right. So to me, it's like a feather in the cap of trend following. Of like, you would need an army of analysts and all this exposure to be like, I researched all these lumber. I bought into this lumber mill that's publicly traded, or I bought this timber. Right. And here it's just part of the portfolio, and you get that exposure in a measured way. And it's like, it's a long call option on things like that happening. Right.
Yeah, that's right. You're right. I mean, even if you think you got all the fundamental reasons for, what a market is going to do or what it should do, sometimes, the markets completely go the opposite direction, and you put your hands up like, why?
Yeah.
I'm, that's the greatest thing about the disciplines of being a trend follow systematic managers. You don't have to know why.
Don't have to know why. And then another one, carbon credits. Are they part of the portfolio yet? What are your thoughts on that? Like, to me, I think it's a weird thing to think about, right? Because by definition, they should go up. They've reset plus 15% a year or whatever. So it would seem to be a perfect thing for a trend following portfolio.
Yeah, we do not have it in any of our portfolios right now. And we also don't have like Bitcoin in our portfolio as well. There's a couple reasons for it. From a standpoint of the mutual fund, the oversight of that distribution of the mutual fund, they disallow it to be in our portfolio. So that one program can't have that. And then we've gone in front of, several of our investors in the past to add the VIX or to, some other markets, and they don't tell us we can't, but we just sort of look at some of the returns from some of those markets, and we feel like it's a little bit of a dangerous move to get in, especially the VIX.
Yeah.
Where you think you're going to get out and where you do get out of some of those markets is not, is not the same. So, we're staying away from some of those markets. We still have a lot of diversification in our portfolio, between commodities and financials, currencies.
The crypto always seems like a perfect fit for a trend follower, right? Like, just take a little bit of risk and you're going to get some of these outlier moves and rinse and repeat, have the ability to go short. So I'm sure you guys will revisit that down the line.
Absolutely.
As the futures become more entrenched too, and the liquidity gets better. Let's finish it up with two truths and a lie. It's new this year. What do you got? Three things about you, one of which is a bit of a stretch.
I'm a good golfer. That's
Good
a
golfer.
good question. Good golfer. Good at these podcasts.
You're making it tough now. And
yeah.
3, that you're not God, and the sun beaming down from behind you there is just the normal sun. Can you see that on your screen? The sun's like,
oh yeah.
Good.
No, honestly, I think I'm good at what I do here at EMC, from a standpoint of keeping the philosophy of what we do from a research standpoint and, managing the company. But I'm not the smartest guy in the world. I mean, I surround myself with some very brilliant people at the company here who've been with us for several decades.
Yeah.
And, and I'm loyal to them. Liz was very loyal to me. I'm loyal to them. I pay them what they're worth because I want them to stick around here.
Yeah. Teach them well enough to leave and pay them well enough that they won't want to. I think
That's right.
That's how the line goes, right?
That's right.
Well, thanks, John. Any other last thoughts before we let you go? Tell them where they can find you and all that good stuff.
Oh, sure. You can find us at www.emccta.com.
EMCCTA.com. Cool. And then we're doing a white paper on trend following, which you guys will be highlighted a little bit in. So check that out. And thanks for listening. Thanks, John.
Hey, thank you.
It's fun.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.